What is your sense? What are investor expectations? Would people get frustrated very quickly if growth doesn't rebound and we continue to make a bottom on some of these variables through 2013?
I think people will be looking for signals in terms of where it's going rather than the near-term numbers, Prashant. I think that's what's happened this year with the flows. People are looking forward. I think even next year you're going to see people looking forward to get a sense of what the trends are. So they may not be so focused on the near-term numbers, though that will guide some of the thinking, but more the direction as to where is this going. You'll have a budget early next year, which will again give you a sense of the way the government's looking at the next fiscal. All of that will be looked at quite closely, I think, to get a sense of how things might pan out.
Do you think it possible with $23 billion and 30% stock market returns, both these things will act against the Indian market as we head into 2013? Because one thing which might explain these very strong flows was the relative underweight position of global funds, etc., on India. That is now reversed. China was a huge underperformer. On the last 2 weeks that started to perform. So China might be the India of 2013. Is it possible?
No, that's a very good question, and it's the right question to ask, because with the structure of flows that we've seen and our structure of our markets, where we are so dependent on foreign flows for the kind of returns we've seen, we are very much competing on a global scale, or at least in an emerging market scale, for these monies. So we will have to compete with the Chinas, the Indonesias, and the Koreas that you mentioned to continue to be an attractive destination. That's where I think it will be important to continue to see reform, continue to see the uptick in GDP. But I think the other countervailing factor to that could be just retail flows, because retail flows have been fairly damp during the course of 2012. Much of the returns have come, as you said, from foreign flows. So whether retail flows can kickstart or domestic flows can kickstart, could be a countervailing force to foreign flows.
Where is all the retail money going? Is it going in fixed deposits? Is it going in real estate?
So I think what we've seen over the last couple of years is, I think you've seen physical savings actually increasing relative to financial savings, and that's partly, I think, probably a factor of a couple of things. At one level, you've seen high inflation, and therefore real rates have been under some pressure, and when that happens, I think investors are reacting like you'd expect them to, which is looking for assets that give them protection against that, and that has typically been gold and real estate, and you've seen a fairly significant increase in exposure to both those classes over the recent past, and financial savings have taken a beating. I think as inflation stabilizes, as you start seeing real returns increasing, hopefully you should start seeing money coming back into financial assets. So I think that's that's at one level what we are seeing. On the other hand, what we've seen at least over last year is, if you look at retail and institutional flows, and I take mutual funds for instance, I think institutional flows have been fairly robust in mutual funds over the course of 2012.
But I think retail is still pulling.
Retail is there. I think you're seeing retail flows, especially we've seen, for instance, in fixed income, good retail flows. Equity flows have been fairly muted, but on fixed income, we are continuing to see flows with people who are willing to take slightly longer term views on interest rates.
But I think that should also start to change once the RBI starts dropping rates.
That should change. So you will start seeing gains in fixed income funds if that happens. So you should therefore see some attraction there. That should have an impact on equity markets if interest rates start coming down. So you should therefore start seeing more retail participation in there. But that's an important thing to look at. It's not just what we do relative to other markets, because that will drive FII flows, but what we do internally to get retail flows back into the market.
You think it'll be a year when retail comes back to the marketplace?
I certainly hope so, because I think retail has stayed out of a lot of financial instruments over the last year and a half. So I think if you start seeing, like we said, real rates getting to be positive and some sense of the economy turning up, I think you will start seeing money coming back.
Actually, if you think about it, I don't think retail has come back after the last crash, which is now 2008-2009.
You're right. You haven't had a big surge, and if you take, say, the stock market and you look at volumes continue to be fairly low if you look at just retail delivery based volumes. So yeah, in a fairly broad range of asset classes, retail has been on the fringes.
The one assumption that I think most are making, so I can just say maybe the consensus is making, is that interest rates will drop in 2013. I mean, some are saying could drop 50, 75, 100 basis points, but they will come off. Where do you stand on that?
Yeah, it's consistent with my view on inflation, and therefore I believe that interest rates will probably come off 75 basis points, maybe a little bit more than that over the course of the year, and that's driven by my view on inflation kind of coming under some control. If you look at the good news from our perspective is, in spite of this global liquidity, commodity prices actually haven't really taken off, and commodity prices have a fairly significant correlation with
inflation. They're starting to over the last couple of weeks. I mean, base metal prices are
but I mean it's marginal relative again to the volume of liquidity we're seeing, and that has a significant impact on inflation again from our perspective. So as long as I think you continue to see that playing out, inflation should be under some control, and that should give the RBI some room to look at easing.
75 basis points through the course of the year.
That's right.
Starting in Jan.
That's right.
I mean that should help. That should certainly help.
I think it should help, and I think that should help in a number of ways, like we said.
Lower rates could be the tailwind, and some say politics could be the headwind, the big one, with of course the budget, the 2013 budget. What do you think will happen there? What do you think the budget is going to be presented with an eye on 2014 elections, or it's not going to be that way? It's going to be a good budget, fiscally prudent budget, because the government's still scared of a rating downgrade.
Yeah, I think fiscal prudence and consolidation will obviously be an important area, because there are a number of constituents watching that space. But I think there are elections in 2014, and you have to be realistic about what the budget of 2013 will be in that context. But more globally, from a political perspective, I think the stability in the US now with Obama back in a second term means that you'll continue with the policies of Bernanke, which I think is supportive for asset prices in general. I think in the Eurozone with Merkel and the elections in Germany, I think again you will see the need to kind of keep a status quo so that nothing kind of goes off track. So I don't think you'll see any negative surprises coming up in the euro, which I think is a good sign again for global markets. So back to your theme of 2013, I think both of these kind of make for probably a more stable political environment.
Global political environment.
Yes.
What about India?
No, so I think both of that has an impact on our markets. I think in India, I think everybody knows 2014 elections will be due. They will be clearly looking at what happens in the budget.
Do you think there will be early elections, Ajay? I mean, 2013, late 2013 maybe?
Not from what I'm seeing today, no.
You don't think that? And so yeah, just to come back to the budget, I mean our budget here, 2013. How do you think that will go? Would it be a populist one with lots of sops, or do you think it'll be
it's difficult
a prudent one?
Difficult to call, Prashant. I think obviously there will be an eye on the election, so I think we'd be naive to expect that there wouldn't be anything as a result of that. But I think there will be several pro-growth measures in place, and I think the pace of reform in my view will continue.
Do you think this rally in markets which started, I'm talking about stock markets now, which started sometime in September, and the bulk of gains has come after that, after reform announcements, etc., would stall somewhere in February, March, I mean around the time the budget is presented, and then it's going to be just basically consolidation, sideways market till you get basically till the time you get the 2014 verdict. Is that possible?
I mean, it's difficult to call shapes of markets so much in advance, but I think you will probably see some expectation running up to the budget. So you could see some continuation of momentum, till the budget, and then it really depends on how the budget, pans out to see how things will work out past that. I think it's a little too early to call the shape for the rest of the year.
What are the other factors that you think will influence, asset classes in 2013? We've spoken about interest rates, politics.
So I think liquidity, I think politics, I think in some sense the whole geopolitical scenario, Prashant. I think the whole situation in Iran, the situation in the Middle East, I think there are obviously some tensions around that, and I think that could have some impact on on markets as well as we go forward, especially if there's an impact on oil, what that does to India. So I think we should keep an eye on the geopolitical scenario. We should keep an eye on the fact there is very supportive liquidity environment, and I think globally a fairly supportive political environment.
I just want to talk about this global liquidity. I mean, that's essentially what is underpinning everything right now. I mean, Bank of Japan is in a way joined the party with the new government in place. Fed is printing, ECB is easing. It's almost as if we're in an unreal environment. I mean, printing somewhere is affecting asset prices here. I mean, take the Mumbai real estate market, for example. I mean, it's going nuts. Well, what's your sense? I mean,
So I'm not sure whether there's
forward.
a direct correlation between the global liquidity and the Mumbai real estate prices, but I think the whole liquidity thing is really to make sure that asset prices stay high, so you create a wealth effect, and that allows people to start spending again. I mean, that's really the counter to squeezing hard on austerity, which is what some countries in Europe have tried to do. So it is a very different approach. It's not an approach I think we've seen at this scale ever in the world before. So it is different to what we've seen before.
No, I mean, if you take that one step forward, essentially the conclusion is that drawdowns in asset prices will be very brief. They might be sharp, but they will be short-lived, and markets will bounce right back because money is being printed.
True,
and it's going to be printed for.
And then that's really what we can see in the near term. I think what you need to think about is what happens if inflation comes back, and then what happens if money supply starts getting contracted. Then what happens to asset bubbles that will inevitably get created as a result of this liquidity flow. I think that's a really that's a bigger question. I think in the interim, otherwise what you are seeing is very supportive liquidity. You will see bouts of volatility as money moves from one asset class to another, but by and large it's supportive of asset price inflation.
What are your views about real estate? I know it's a very fragmented market, can't really talk about, I mean, everything in one shot, but what's your sense?
Yeah, I don't think it's one market, and I think, like you say, there's the differences in terms of cities. There's difference obviously between commercial real estate and residential, and there is a difference in terms of price points, very clear difference in terms of price points. So at the underlying level, I think we continue to see and hear about fairly significant demand if you look at the mid level of the market, as it were, and across the different towns that we cover. We continue to see reasonably good growth, and you can see that in a number of the housing finance companies and the kind of growth they are seeing in housing demand. At the top end, and maybe in some areas in terms of commercial estate, there is clearly oversupply.
Gold. What's your sense? Gold prices.
So my sense is gold is related to two things. It's linked one level to what happens to inflation. And that's driven some of it, but it's also in many ways a safe haven. So if there continues to remain uncertainty and volatility in the world, gold is always a safe haven investment. So if the world becomes a little less volatile, a little less unpredictable, and if inflation comes down, then you should see gold prices coming off.